217,000 jobs were lost in Q1 2026 alone. This isn't just a stat, it's a fundamental shift between 2008 versus 2026. Let's give an example. This is a Google developer or an Oracle developer. He was making $150,000 to $350,000 a year. But let's just do midpoint, $250,000. And he lost his job last summer, okay? Hence, frowny face. And now it's been 7 months. Bills are coming past due. What happened? Now this. 2008, this 1.7 million is the number of repos in 2008, 2009. 2026, it's projected to be 3.1 million. Double that. Now, this is also the part that gets extra scary. We have a member of a person in our community who works in real estate. He was mentioning something that should scare everyone. Last year of 2025, there was only one defaulted mortgage that he had for the whole 2025. Come just March 2026, over 50. Now that is a 600% increase. Remember, trading comes down to 2 things, risk management and pattern recognition. Risk management is realizing it's very risky relying on one single source of income and relying on corporate America because we all know they do not give 2 about you. Pattern recognition is recognizing you are a number on a spreadsheet. Reason why I say that is because I used to be that person. I used to be in corporate finance and asking every department, hey, so we need to increase your margins. Therefore, the only way, because they're not going to increase it in sales, by cutting people. That was literally my job. Now let's get to the charts. The SPY right now, we have gapped up. We had a very large reaction because the President Trump said, hey, we are going to ceasefire for, the Middle Eastern conflict. And of course we had a massive reaction, right? This massive gap up. But as an institutional Wall Street trader, you have to look between the lines. So let's take it a little bit of a step back. Let's go to the weekly. From this reaction, we had a bounce, right? Last week, because there was Good Friday, the market was closed, so it was only a 4-day week. This week of the close of Friday, April 10th, the candle is massive. The volume, not so much. I don't know if I'm believing in this move. And the reason why I know this is because, first of all, we train with our eyes. Price can be manipulated, but volume cannot be. This appears to be kind of like a manipulation because we have this massive candle, but the volume sucks. Also, if you read Volume Price Analysis by Anna Kohling, you'd also know that you can train your eyes to look like this. Also, if you want to work with me, link below and join our 1,200 plus professionals. I'm going to also go over one of our professionals. He is one of our students. Alec called it out an absolute banger. Okay, so Alec is actually an engineer and he's very busy. And he called out Hog on the monthly, and I'm going to go over this. Alec is one of the best students. He has a wonderful eye for price action, and he's also just really funny. Anyways, Harley Davidson dumped. We had this massive dump. You can see the pattern, and now we have a double bottom formation pattern. On top of that, this is what every alarm bell should go off. We have a bullish engulfing candle with volume that's double. Remember, price can be manipulated, but volume cannot be. We know that this volume is institutions loading up. Then if you isolate a little bit more, you go into the options flow chain. Well, we saw volume spikes on April 9th, 3,000 contracts. Retail just didn't be like, I'm going to start buying Harleys. No, look at the key strikes. Their sweep activity. Hook call ratio was actually 1.7, which is usually bearish. However, it was appearing to be hedging, and it definitely was. Because the other thing too, risk to reward was fantastic on this. On top of that, it moved 17% in a single, less than 2 weeks, guys. That is massive. And that's the reason why we were able to get these kind of gains. On top of that, he did a spread, which is very, smart given the actual environment, very risk on. You can, pay less, you don't have to put as much capital up. So fantastic. Great job to you, Alec, because our 1,200 plus professionals, we got on the trades too. Now I'm going to isolate CVX. And this was actually another community member. I want to call him Dale, our CFO man. He called this one out. First time he was actually home. Massive dump because his specialty, and mine too, is actually bounces. So we had this massive dump because President Trump was saying, hey, ceasefire, right, for 2 weeks. So obviously the sector rotation was everything else ripped, energy dumped. However, we closed at the end of the day with a hammer candle, brushing the lower Bollinger Band above average volume. We basically played off the daily, just a temporary bounce. And so we did kind of short-term expirations, and I did spreads because I want to be risk managed. It all comes down to pattern recognition and risk management. I set my alerts along the way to take profit. I really thought we were going to go a little bit more, but we didn't, and that's okay. I'm going to take what the market gives me because After I started setting my alerts and I saw price action on the lower time frames going down, I was like, this is my exit. I'm peacing out. I got out with like 50%. Also to note, even though CVX closed in a bearish engulfing candle, we set alerts along the way because you don't have to wait till the end of the day to take your profits. You just take exactly what the market goes. You set alerts or auto close orders. That's how you manage it, especially while you're working. Guys, do not be like Joe. He has no plan. I have coached over 1,200 plus professionals, and I'm also offering a free course that I typically provide this, and it's usually not free, but I want you guys to all be prepared. Link is below. I'll see you guys in the next one.